Hi guys, welcome to Globalfinx. In this video, we are going to discuss about CBE computer-based examination for Diploma in IFRS examinations to be held from and onwards December 2020. So in the first part, I am going to discuss with you guys how to do consolidated financial statements, which is a mandatory question number 1 of your CBE Diploma in IFRS paper. So I am going to do that particular question in your exam environment. For that, I'm going to use ACCA's website's specimen examination option that is available. So first open your browser and just navigate to Google and search for DIP IFRS CBE Specimen. DIP IFRS CBE Specimen, and you can see the first option itself is CBE Specimen Examination. So just click on that and scroll down and you can see launch external site, that is CBE Specimen. You can click on that and it is going to launch a separate website. So while this is being launched, let me tell you guys, all your regular paper pattern will be the same. You will have 4 questions, 25 marks each. First question will be from consolidation and the remaining 3 will be from various accounting standards, IFRS and IAS. So let me just switch to full screen. This is exactly how your actual CBE exam will look, with little bit of modifications. That is, you will not be having an explain answer option in your exam, which is obvious common sense, isn't it? You will not have an explain answer option. For specimen paper, they have added this for your understanding purpose, that's all. And you will have 3 hours 15 minutes and there is no reading time as such. You can directly start your answer from minute number 1 itself. So you will effectively have total 3 hours and 15 minutes completely available for your answering. And then you have your highlighter. You will have a strike through option just in case if you need them. Control C, Control V will work as usual. Copy paste will work as usual without any problems. So yeah, you'll have a formula sheet if required, but I don't think for Diploma in IFRS you'll be having any formula sheet requirement. Yes, and then you'll have a symbol option where you can add symbols like dollars, pounds. If in case any foreign exchange related questions from IAS 21 pops up, then you might be required to use this symbol options from the screen. And you'll have a scratch pad, which is basically a rough work, but I don't think students will usually use that because the time constraint is already there and we don't want you to waste any more time on the scratch pad. But if you think it's required for you to use a rough notebook, then you can use a scratch pad which is available on the screen. Okay, so you have 4 questions, 25 marks each, 100 marks. So even if I ignore 15 minutes, maybe for review time or maybe for a break or maybe for doing nothing in the exam hall, still you'll have effectively 3 hours. So if I consider 3 hours for 4 questions, that's 45 minutes effectively each for each question. 45 minutes for each question. So make sure that in your examination you will have a timer on your screen, but I would suggest that you guys still carry your own watches and make sure that at every 45 minutes you guys actually finish a question, and if a question is not completely finished in 45 minutes, please switch on to the next question because you will get partial marks at least. For the attempted question, even if you leave it incomplete, you will be awarded partial marks. So please make sure you are having proper time management in your examination. So moving further, so before I click S, let me just turn on my timer so that we can have a view on how much time we are taking for this particular consolidation question. So I'm starting the Google timer. Yes, it's now started. Okay, for 4 minutes. No, I want it to be 45 minutes. Okay, so I'm gonna start it. Yes, my countdown started for 45 minutes. Let's start this. I might take a little bit more time because I'll be explaining the answer to you guys, but let's see how much time it's going to take. Okay, so if you see the question here, we have alpha, a parent with a subsidiary beta, is preparing the consolidated statement of financial position at 30th September 2017. The following exhibits available on the left hand side of the screen provide information relevant to the question. Okay, you have 4 exhibits on the left side of your screen and they have the information that is required. First, exhibit number 1 is about draft financial statement of position. Okay, draft statement of financial position of alpha and beta as at 30th September 2017. 17. Okay, you may read it as 2007, you may read it as 2017. Absolutely fine, no problem. Okay, but in the exam, whenever you are answering, make sure that you type it as 20x7, not 2017 or 2007. Alpha's investments, details of investment in beta and other equity investments. Okay, apparently the parent company Alpha has other investments in the equity instruments of other companies apart from beta also. Okay, could be an investment in associates under IAS 28, or it could be fair value through P&L or fair value through OCI instruments under IFRS 9. Let's see. Then we have intra-group trading. Okay, there could be provision for unrealized profit to be created, or there could be intra-group balances to be eliminated in the statement of financial position. Both are possible. So let's see. Details of trade between alpha and beta are given in exhibit number 3. Okay, and then there is a share-based payment, IFRS 2 related adjustment. See, usually diploma in IFRS has IFRS 2 share-based payment adjustments a lot. This standard is tested a lot in diploma in IFRS, so please pay attention there. Information on share option scheme provided for senior managers of Alpha. Okay, this information should be used to answer the question requirement within the response option which is provided. Okay, you have the response option of spreadsheet, so you'll have to use this spreadsheet and solve this particular requirement of the question. Let's see what is the requirement. 25 marks requirement is basically using the draft statement of financial position of Alpha and its subsidiary Beta at 30th September 2017, which is given in Exhibit 1. Okay, Exhibit 1 has the statement of financial position of individual companies Alpha and Beta, which we need to consolidate. And the further information provided in Exhibits number 2 to 4, okay, Alpha's investments, intra-group trading and share-based payments. So, prepare the consolidated statement of financial position of Alpha as on 30th September 2017. Okay, we are required to prepare a consolidated statement. So, first let's see Exhibit 1. Before we start our solution, make sure you have all the information in your head, okay, so that you can plan your solution faster and properly. So you are given non-current assets, property, plant and equipment, investments, current assets, inventories, trade receivables, cash and cash equivalents. Then you have share capital, retained earnings, other components of equity is there only for parent, not for subsidiary. Okay, cool. And then you have long-term borrowings, deferred tax, and then current liabilities, trade and other payables, short-term borrowings, and then total equities and liabilities. Okay, this is a pretty straightforward question. There are no complications in the SOFP of parent and subsidiary individually. Let's see the adjustments. So before I move on, let me just very quickly copy this information. So why are you copying this information? Because this will help me to fasten up my process of solving this and preparing the consolidated statement, because I don't need to switch between question and answer all the time. I have the information that is required within my reach. So this will this will reduce my required time a lot. So let me just sort it properly. Yes. Okay. And what I'm going to do is I'm going to just move this a little bit to my right so that I can use the consolidated statement here. And please see very carefully what I'm doing. I'm just copying this entire information of either alpha or beta. Anything is fine. And just paste it here. And immediately what you will do is, okay, rename this as consolidated. That is the first requirement. And remove all the figures. Investments, inventories, PPE, all the figures, make them 0. Don't delete anything, just type 0 and remove them. Okay, why I'm telling you not to delete is basically to let the formulae stay there. Okay, and now just a small adjustment. See, this is where your preparation actually comes into place. See, what I'm doing is, unfortunately in the CBE platform, you cannot right click and add a row here. In normal Excel, we can just right click and add a row here, but that option is not available in CBE. So what we need to do is basically, if I want to add a line here, for example, I know there is going to be a goodwill. Okay, either a goodwill or bargain purchase, I'm not pretty sure. But if there is a goodwill, I'll have to show it in the non-current assets region. Here I have to show. So I want a line here, I want a row here, not possible. So what I'm going to do is, I'm going to very quickly select the entire concept which is there and cut that and paste it one line below. Okay, so now I have a line here. I'm going to name it goodwill. I hope you are able to understand what I'm trying to do. Okay. And similarly, I know that in the equity portion, there's going to be a non-controlling interest. So I'm going to just move this one line down. Okay, so here I'm going to put non-controlling interest. Okay, so these are something, this I know that there is going to be a non-controlling interest, so I'm adding that line here. Similarly, I did one for goodwill as well, right? Okay, so now I have my format ready. Let's move on to the adjustments. So first adjustment that is given is investments of alpha. Okay, so what are the investments of alpha here? Pardon me. The investments figure in the individual financial statements of alpha is made up of the below details. One is investment in beta, that is the subsidiary company, 236,500 in thousands. This entire question is in thousands, so please be very careful. Okay, then you have investments in beta, 236,500. Then other equity investments are also there, which is 13,000. Okay, there are investments in other companies as well, which is 13 million usually. Okay, then regarding the alpha's investments in beta, this is the subsidiary. So usually we get the purchase consideration paid by parent, net assets at the acquisition date, related information like retained earnings of subsidiary at date of acquisition, fair value adjustments of subsidiary at the date of acquisition, additional depreciation related concepts, fair value of NCI if fair value model is followed. Otherwise, they will mention that the company is following the proportionate goodwill method. Whatever, that information is usually available in this particular portion, right? So let's see. Alpha's investments in beta on 1st October 2014. Okay, this is a key information. Now, this piece of information is very key information. So why, sir? Because this is where what do you call it? The date of acquisition comes into the picture, whether there is any mid-year acquisition or is it a full consolidation. And similarly, for calculation of additional depreciation if required, we have to consider the time period since the date of acquisition. So for us, the date of acquisition here is 1st October 2014. Alpha acquired 90 million shares in beta by means of a share exchange. Okay, 90 million shares are acquired. Share exchanges of 2 shares in alpha for every 3 shares acquired in beta. Okay, so 90 million shares into 2 by 3, that is 60 million shares of alpha are issued to the previous shareholders of beta. Okay, on 1st October 2014, the market value of an alpha share was 3.9. Okay, so purchase consideration paid by parent will be 90 million into 2 by 3 into 3.9. Okay, alpha incurred indirectly attributable costs of 2.5 million on acquisition of beta. Okay, this is a key area, so let's just discuss that. Alpha included these costs in the carrying value of its investments in beta in its own statement of financial position. These costs comprised of 1 million, which is cost of issuing own company shares. Okay, and then there is 1.5 million of due diligence cost. Okay, let's talk about this for a moment. See, Alpha has acquired the shares of beta, and while acquiring the shares of beta, Alpha has issued its own shares in the ratio of 2:3. Now, previously, I'm talking about a few years back, we used to have the concept of share certificate. Whenever shareholders are changing, the company has to prepare a share certificate, a physical form, and that has to be sent to the new shareholder. So there used to be a lot of cost, and then first you need to get the share transfer registered with the Ministry of Corporate Affairs or Register of Companies or whatever companies related authority you have in your country. Then you have to intimate the respective people. Internal board of directors meeting may be conducted if required, if it is right shares or right issue or bonus issue or something like that. Internal board meetings, etc., needs to be there. Lots of regulatory complications used to be there. Okay, so all those things need to be filed with respective authorities. In this case, they said that cost of issuing own shares are 1 million. Nowadays, after dematerialization of shares, when demat accounts are in force, I don't think the cost of issue will be 1 million as such, but okay, cool. The information is given, so we'll take it. And similarly, there is 1.5 million of due diligence cost. Now, what is due diligence, sir? See, basically, if I want to acquire a company, I might be doing a basic research like what is its statement of financial position, what is its financial performance, what are its ratio analysis, how well is it composed of its debt equity mix, how well is it geared or leveraged, or what is the management's competence and their skills, what are the upcoming projects, does the company have any contingent liabilities on its balance sheet, are there any pending court cases against that company, or Does it have internal control systems which are efficiently and effectively working? Are there any past recordings made by the previous auditors of the company? Were there any internal reconstructions happening? Or is the company having solvency or not? Is going concern really an issue or not for that particular company? I'll have to do hundreds of research points regarding that particular target company, right? So that entire process is called as due diligence. Okay. So for that, they have incurred a cost of 1.5 million. So if you think logically, let us say IFRS 3 goodwill calculation for a moment. Ignore that. Even if you don't know the standard, okay? Simple concept. Goodwill is what basically whatever extra consideration we paid to acquire that subsidiary company. Common sense. Now, are you paying this consideration to the subsidiary company's shareholders? Are you paying that 1 million and 1.5 million to the subsidiary company's existing shareholders? Is it a part of purchase consideration or not? Absolutely not. This is not a part of purchase consideration because you are not paying that to the shareholders. You are paying that to whatever issuing authority or whatever, whoever is doing that due diligence. That is your internal matter. Subsidiary company has nothing to do with that. These costs are not incurred for the subsidiary company. These are incurred as a matter of your internal part because you wanted to acquire the subsidiary. These are indirect costs. These are not directly attributable to the acquisition of subsidiary. So this cost of 1 million and 1.5 million shall not be considered as a part of consideration. Purchase consideration will only be 90 million into 2 by 3 into $3.9 per share. That's all. This 1.5 million and 1 million will not be included in consideration. Rather, this will be reduced from the retained earnings, or if you have share premium, this cost of issuing own shares, that is 1 million, will be reduced from the share premium or any other reserves if you have other reserves. If you don't have any other reserves, you can adjust them with the retained earnings. Okay, this 1 and 1.5 will be adjusted from the retained earnings or other reserves, not from goodwill. It shall not form a part of goodwill calculation, right? Then moving on 1st October 2014, the individual financial statements of Beta showed retained earnings of 60 million. Okay, the retained earnings at the date of acquisition is 60 million. Then the directors of Alpha carried out a fair value exercise to measure the identifiable asset. Okay, there are some fair value adjustments. I'll read this later when I have the format ready. Okay, after preparing my working note number 1 and 2, then I'll read this information. I don't want to do duplication now. I just don't want to waste time. Okay. On 1st October, the directors of Alpha initially measured non-controlling interest at its fair value. Okay, they are following the fair value method of goodwill. So we'll go with that. Okay. Other equity investments in Alpha, these investments are classified as fair value through P&L. The fair value of these investments at 30th September were 13.8 million. Okay, so it is a fair value through P&L instrument and fair value on the reporting date is 13.8. Whereas fair value on the acquisition date is 13 million. So 0.8 million of gain is there, which is to be shown in the retained earnings. That is P&L basically. My working note number 5. 800,000 profit is there. Then intra-group trading, if I see, very small adjustment is there. Alpha provides Beta with management services and levies a monthly charge for these services. Okay. On 29 September, Beta made a payment of 8 million to Alpha to eliminate the amount owing to Alpha at that date. Okay. This payment was received and recorded by Alpha on 2nd October. Okay, basic common sense adjustment only. Subsidiary has sent $8 million to the parent company 2 days before the closing. That is 1 day before the closing. On 29 September, subsidiary made the payment, but parent received that after 2 days, that is on 2nd October they received. So what we will do, we will deduct that 8 million from the receivables of parent because it's already been sent by the subsidiary. We'll reduce that 8 million from the parent's receivables and we will include it in the cash in transit, that is cash and cash equivalents. We'll add that 8 million. So basically reduce receivables, increase cash, your balance sheet will remain the same. It's very small adjustment that should not make any disturbance for you. And regarding share based payment, let's see. On 1st October 2015, Alpha granted 200 of their senior managers options to buy 100,000 shares each. 100,000 shares each between 30th September 2018 and 31st December 2018. So the options vest on 30th September 2018. Issue date is 1st October 2015. So 16, 17, 18. 3 years vesting period is there. Okay, cool. So usually we create the provision spread across 3 years. 1 by 3, 2 by 3, 3 by 3. Okay. Then the options are due to vest on, okay, number of managers in whom the options, okay. Expected number of managers are given in 2015 when the options were actually issued. We expected all the managers will use that. After 1 year, we are expecting only 180 managers will stay till the end of the 3rd year. At the end of 2nd year, we are expecting 190 managers will stay in our company for the another year. Okay, cool. No problem. So for 2nd year, it will be 180 managers into 100,000 shares. But since we are solving in thousands, I'll take only 100. 180 into 100 into 2 by 3 into fair value of each option. Where is the fair value of each option? Okay, last paragraph, if you see, on 1st October 2015, the fair value of each option was estimated to be 1.2 and subsequently it was measured at 1.25 and 1.3. Again, 90% of the students will use that information of 1.25 and 1.3, then they'll cry after the exam. Ma, IFRS 2 share-based payments, the fair value of the option at the date of grant shall be considered, not at the reporting date. For share-based options, for stock-based options, we have to consider the fair value of each option at the grant date, that is 1.2 only shall be considered. 1.25 and 1.3 will be ignored. Please, many students do this mistake. They'll calculate using this 1.25 and 1.3 and then cry after the exam. So please be careful. Your answer will tally. Even if you take 1.25 and 1.3, your answer will tally, your balance sheet will tally. Okay, your balance sheet will tally because that's the wrong calculation which is affected on both the sides of the balance sheet. So please be careful regarding the such kind of compensating errors. Okay. Chalo. And look at this information. In preparing the financial statements of Alpha for the year ended 30th September 2016, that is last year, the directors of Alpha debited retained earnings and credited other components of equity, which is the common journal entry, which they had to pass for provisions, right? From profit and loss, transfer some portion to other components of equity, which is the share reserve. Okay. Appropriate amount required as per the IFRS 2, the directors of Alpha have made no additional entries in respect of this arrangement in the current draft financial statements. Okay, last year provision is already created, current year provision should be created. We should create that provision. Okay, so last year provision we can calculate as 180 into 100 into 1.2 multiplication basic. Current year required provision will be 190 multiplied by 100 multiplied by 1.2. The difference amount will be provision that is required to be created in the current period. Okay, seems pretty straightforward. I don't think there is any complication involved in this particular solution. So I'll go forward and start with my working notes preparation. Chalo guys, pay attention. Working note number 1, group structure. Let's go. Number of shares of subsidiary, that is beta. How many shares are there? Subsidiaries balance sheet, if you see here. Okay, this is beta. 120 share capital, 120,000, and this is $1 share. Each share is $1, so 120,000. If each share is 50 cents, number of shares will be 120 divided by 0.5, that is 240,000 will be there. But since this is $1, number of shares and share capital will be the same. So 120,000 shares were there. And this is in thousands, so I am gonna keep this in thousands mark here. Otherwise, your answer will be wrong. You have to make sure that you are mentioning this in your answer. Next one, shares held by parent, that is Alpha, is equal to 90,000. Sir, how do you know 90,000? You should remember this kind of information. Okay, you are not doing 7th standard, 8th standard maths anymore. You have to remember basic information from the question. Cool. Parent has acquired 9 million shares of subsidiary. If you remember, see, 90 million, sorry, not 9 million, 90 million shares of subsidiaries. So I took 90,000 here. So if I mention it as a percentage, 90 million by 120 million, that's 75 percentage. So let me just keep it as a percentage here. Then shares held by NCI, non-controlling interest, will be how much? 120 minus 90,000, that is 30,000 divided by 120, that should be 25%. Okay, 25% is held by NCI 75% by parent. Date of acquisition will be 1st October 2015. 1st October 2014. Period of holding total 3 years. Period under consolidation total 12 months we are considering for the current period consolidation, not any partial mid-year acquisitions and all. Next, working note number 2, net assets of subsidiary, that is beta, at acquisition date, at reporting date and post acquisition. Okay, some people usually ignore post acquisition column and directly at the end they will do for the at acquisition and at reporting date. The difference will be directly taken as post acquisition. Anyways, it's fine, ma. You can either do post acquisition line by line, or after getting these two columns you can directly calculate the difference between the totals and you will get the same thing. Absolutely fine, no issue. I'll stick with the line by line items. So share capital, then we might have retained earnings. We will have retained earnings. Other components of equity. Okay, these three are mandatory to be taken. So share capital of subsidiary, we already know 120,000, right? 120, reporting date also 120. Post acquisition will be reporting date minus acquisition date. Post acquisition is reporting date minus acquisition date. F2 will not work. If you want to check or if you want to edit a cell, you have to double click on that. F2 function will not work like normal Microsoft Excel. And retained earnings of subsidiary, retained earnings of subsidiary, this is parent. Subsidiary is 168,000. Okay, so at reporting date 168,000. At acquisition date, I don't know, I'll have to check. So what is the retained earnings of subsidiary at acquisition date? 60 million. See, on 1st October 2014, the individual financial statements of Beta showed retained earnings of 60 million. So 60,000. So that is 108 is the post acquisition retained earnings. Cool. Then what else? These fair value adjustments. Let's see these fair value adjustments. Oh shit. Array, it got over zoomed. Okay. Just stay there, come on. This is time waste in the exam. But this will not happen for you in the exam because control scroll will not work for you in the real exam. So that shouldn't be an issue for you guys. Okay, instead of zooming this, I zoom the entire window. Cool, no problem. So, okay. So here if you see, the first information is freehold land which had a carrying amount of 150 million had an estimated fair value of 120 million. Okay, so first one is fair value gains for land. Okay, other components are not there, so I'm putting it 00. Okay, fair value gains of land at the acquisition date, it is how much? 150 million. Okay, sorry, 210 million is the fair value, but we are showing only at 150 million. That means 60,000 is our fair value gain. Okay, there won't be any additional depreciation because this is freehold land. Land will not have any additional depreciation concept, so I'm not ignoring that. See, if revaluation gain is there at acquisition date, the same will be there in balance sheet today also. So we have to take it on both the columns. Okay, some people will show here directly net of additional depreciation. I would like to show it two separate lines according to your convenience. So next one is plant and equipment having a carrying amount of 121 million had an estimated fair value of 145 million. Okay, so this second adjustment is again revaluation gain. Instead of land, it is property, plant and equipment 145. Yeah, 145 million minus 121 million. So that's 24,000 revaluation gain is there. Okay, then The estimated remaining useful life of this plant at 1st October 2014 was 4 years. Okay. See, this 24,000 has to be depreciated in 4 years. So each year 6,000. It's been 3 years since we acquired the subsidiary. 2014 we acquired, 15, 16, 17. 3 years since acquisition. Per year 6,000. 24 by 4 is 6,000 per year. Into 3 years 18,000 it will be. So less additional depreciation on PPE fair value. So it will be how much? Minus, sir, why minus, sir? Because we have to deduct that 24,000 by 4, that is per year depreciation, into 3 years since we acquired the subsidiary. So we have to deduct 18,000 from that. Okay, then third one, the brand. Okay, there is some brand also now. See here, a brand name relating to Beta had a fair value of 25 million. This brand name was not recognized in the individual financial statement of Beta as it was internally developed. Okay, makes sense. Under IAS 38, internally developed intangible assets shall not be recognized in the statement of financial position if the fair value cannot be determined. But as per IFRS 3, when you are doing consolidated financial statements, while calculating goodwill, we have to take this fair value of intangible assets of subsidiary which are not shown in the balance sheet as well. So fair value of brand intangibles. So how much is the fair value? 25 million. 25,000. 25,000. Less amortization on brand. At acquisition it will be 0. Post acquisition at reporting date it will be how much? So what are the remaining useful life? The directors of Alpha considered that the useful life of this brand is 25 years. So 25 million, 25 years. Every year 1 million amortization. It's been 3 years since we acquired the subsidiary. So 3 million will be the amortization, right? Minus 25,000 by 25 into 3 years. So 3,000 will be the amortization. Cool. Very easy. Let's go. Okay, the fair value adjustments have not been reflected in the individual statements, which is common sense. In the consolidated statements, the fair value adjustments will be regarded as timing differences for the purpose of computing deferred tax. Okay, cool. We already know that whenever there is a fair value increase, revaluation gain, that will result in deferred tax liability, correct? The asset base in our books of accounts will increase, the tax base will remain the same, so that will create a deferred tax liability. And as and when additional depreciation is charged, a deferred tax asset will be created in order to reverse that deferred tax liability. I don't know if you recall this or not. If not, go back to your IAS 16 property, plant and equipment, IAS 12 accounting for taxes, and there you should find this revaluation concept. And I hope students also remember that when there is a revaluation gain, the revaluation gain related deferred tax will be created in OCE, not in P&L. Okay, the liability portion will be net off, squared off in the OCE component itself. I don't know how many of you recall, but go back and recall if you don't remember that. Okay, chalo. So they're asking you to consider these timing differences as a temporary timing difference, and you are supposed to calculate deferred tax adjustment at 20%. Very simple, nothing much. So less, since this is a liability, it has to be deducted from net assets of subsidiary. Deferred tax liability, I will calculate it as a minus sum of including land. Even though land does not have depreciation, it shall still be considered as a timing difference. It shall be considered for calculation of deferred tax. Go back to PPE and remember this concept. So all of these things into 20%. Okay, that's 21,800, and here also is equal to minus sum of 60, 24 minus 18 plus 25 minus 3,000 into 20%. Okay, so there is net increase of 4,200 in the net assets because liabilities are decreasing. Okay, see, as at the acquisition date, deferred tax liability is 21,800. Today, deferred tax liability is only 17,600. So that reversed portion is increase in the net assets. Chalo. So total net assets of subsidiary will be how much? Is equal to sum of all of this. Okay. Chalo, 91,200 is what? Post acquisition increase in the net assets of subsidiary. Okay, I'm gonna close this. And from here, I don't think I'll need the information other than share-based payments. So I'll keep that on hold. So I'll move forward. Working note 3, that is goodwill calculation, right? We don't know whether there will be a goodwill or there could be a bargain purchase as well, negative goodwill as well. So purchase consideration paid by parent through share exchange is equal to 900,000 shares, sorry, 90,000 shares into 2 by 3 into 3.6, if my memory is serving me right. Let's see, let's not be overconfident. 3.9. See, that's what happens when you're overconfident. So here I'm gonna take 3.9. I'm cool in accepting my mistake. It's 3.9. Okay. Then fair value of NCI, non-controlling interest, is how much? Okay, on 1st October, the directors, 1st October 2014, the fair value of equity shares in beta was 2.35. Okay, so NCI value is to be calculated as number of shares into 2.35. So NCI has 30,000 shares into 2.35. So NCI is 70,500. Total consideration will be how much? Sum of this two. That's 30,000. Sorry, 304,500. Okay. Less net assets at acquisition date. So net assets of subsidiary at acquisition date as a minus figure 267,200. So goodwill at acquisition date is how much? That's 37,300 goodwill. Okay. Less impairment, if any. We know that there is no impairment because we have already seen the entire question. So net goodwill will be 37,300. So I'll immediately go to my consolidated balance sheet. I'll go to my goodwill is equal to 37,300. Oh, why is the total not updated here? Okay, see, these kind of mistakes could be there. So please be careful when you are doing adjustments. Goodwill was not included in the subtotal. Okay, so please be careful. Now I included that. Then moving further, working note number 4, that is non-controlling interest. So non-controlling interest fair, okay, I'll just copy this. Fair value of NCI at acquisition date is 70,500. I already have that information. Add post acquisition share of increase in net assets of subsidiary. So what is the net increase in subsidiaries net assets? 21,200 multiplied by their shareholding of NCI is 25%. So they get 25% of that. Chalo. If we have any impairment, that share of impairment 25% also will be deducted here, but there is no such impairment loss, so I'm ignoring that. So net NCI for consolidated statement of financial position will be 93,300. So immediately I'm gonna go back here. I'm gonna add this NCI as well. 93,300. These two items I know again it's the same problem. So this sum is not including this last line, I guess. Okay, we manually added that, so it's not included here. So let me just extend that. Okay, so now it's included. Then last and final working note other than the share based payments. So working note 5, group retained earnings. Okay, parents retained earnings are available in the balance sheet. Parent alpha retained earnings is 550,700. So I'm going to take here 550,700. Then add post acquisition share of net assets thing is there now is equal to 91,200 into 75%. Okay. Then less provision for share based payments. I don't know how much, so I'll just keep a column there and I'll leave it. Then add fair value gain in investments fair value through P&L investments. So how much was that? 13,800,000 minus 13 million. So 800 fair value gain was there. See this one. Fair value is 13.8 million, whereas carrying amount is 13 million. So 800 fair value gain is there. That is also added here. So I'll just leave one more line if in case required. So total group retained earnings will be this sum here. Okay. So 61,99,000. There are still adjustments to do for that. Don't just jump into conclusion. Retained earnings 61,99,000. And then we have working note number 6. That is share based payments. So provision required as on 30th September 2016, 2000X6. So how much was that? This portion is done. Share based payments. Come here, beta. Come here. Expand. Okay. Okay. So 2016 it will be how much? 180 into 100 into 180 into 100,000 shares per employee manager into 1 year, right? 1 by 3. This vesting is for 3 years. 2016 lapsed 1 year, so into 1 by 3 into fair value of each option is 1.2. Okay, so we need 7,200 at the end of first year, and we had that. They told you already. The directors have already created a provision sufficient as per that. And then Control C, Control V I'll do here. Control C, Control V. Replace 2016 with 2017, and calculation will be 190 employees managers into 100 into 1.2 into 2 by 3. Now this is cumulative. These figures are cumulative. Okay. So net provision to be created in 2017 will be how much? 15,200 minus 7,200. So 8,000 provision needs to be created. That will be deducted from parents' retained earnings. So let's just check. Okay, properly calculated. And then last working note number 7. Working note 7, that is other components of equity. So balance sheet figure already is there, na? Parent had some OCs. See this one, 202,000. So that 202,000 will come here. 202,000. Parents OC. Then less. Okay, add. Sorry. Hey. Add provision for share based payments. 8,000 will be added, and less, if you remember these two things, we have to deduct from other components of equity. 1 million cost of issue and 1.5 million due diligence, plus cost of issue of own shares, that is minus 1,000, 1 million, and less due diligence costs minus 1,500. So net total OCE will be how much? Sum of all these things, that is 207,500. I really hope my balance sheet will tally. Let's see if my balance sheet will tally or not. God's grace. Okay. Chalo. So property, plant and equipment will be 731,200 plus 310,000. See, parent plus subsidiary plus these things. Fair value gain plus fair value gain minus depreciation. Don't do minus of minus. Okay, plus 25,000 plus minus 3,000. Deferred tax will not be added in the assets, so that's all. 1129,200. Investments, as we know, 13,800, because we don't show the investments in subsidiary. Then inventory 140,000 plus 85,000. No adjustments in inventory. Okay. Then you have trade receivables. We know there is an adjustment, that is 95,000 plus 70,000 minus 8 million. 8 million which is already transferred by subsidiary but not yet received by parent. So that is removed from trade receivables and we will add it to cash balance. 16,000 plus 13,000 plus 8,000. So minus 8,000 above plus 8,000 below. That's all. So total assets are 1599,300. Share capital only parent has to be taken. So 240,000 retained earnings and OCE from those respective items. And we got NCI also we have taken from the working notes. So pool total equity 1152,700. Then long term borrowings, no adjustments are there. So 100,000 plus 70,000 of subsidiary. Deferred tax we have adjustments 59,000 plus 38,000 plus we have some calculation related, that is 17,600, but there is a minus symbol there. So I'll have to put minus here. Minus of minus will become plus. So it's 114,600. Then trade payables 60,000 plus 52,000. Short term borrowings is equal to 20,000 plus 30,000. Oh God, what happened? Okay, there is one underscore symbol over there. Okay. Oh, my balance sheet is tallied. Awesome. Party. Hard. Okay. Chalo. So that's our consolidated statement of financial position in CBE platform. And now I can easily remove these things if I want, and otherwise I can leave it like that. There is absolutely no problem in leaving them like that. So you can just leave it as is. Okay. If you want, you can delete this information, no problem. I did not use this as reference links anywhere. I typed everywhere. See, even if I remove also, all my values are remaining the same. Okay, that's why I did not create any links to these figures. So either I can delete it or leave it. Absolutely fine, no problem. I'll delete it just to be sure. Let's not confuse the examiner. So that, my dear friends, is how we create the consolidated statement of financial position. And if I see the timer, I still have 20 seconds left even after explaining every point multiple times, right? Cool. So that's how we go ahead and do that. Chalo guys, I'll wind up the lecture here. We'll see you in the next video with the remaining 3 questions, right? One by one. Chalo. Bye. Take care.